I'm going to talk a minute about concentrated stock positions. So this is something that financial advisors like myself run into quite frequently. A lot of Americans, work for, publicly traded companies, and they're given stock as part of their compensation, or, they've worked at a company that's been very successful, and that stock has just gone up and up and up over the years, and they're very loyal to those companies. So they've just accumulated a lot of stock and just kind of let things go on autopilot, and then they get to a point where they're about to retire, and they're thinking, I've got all this stock, what am I going to do with this? Do I really want to have all this? Or something happens with a company where it gives them concern. So what is a stock that is concentrated? What is the definition of that? Well, I think you'll find some varying opinions on that, but I'm going to go on a limb here, and I'm going to say that if you've got something in your portfolio that's 20 or 25% of the total, then I think you're concentrated. But another way to look at it would be, how much money do you have in the stock? So look, everybody has their own financial situation, and maybe you're worth $10 million, or maybe you're worth $10,000. So everything's relative. But I can pretty easily say that if you've got a large amount of money, maybe that'd be whatever that number may be, but let's just use the number $200,000 that you've got in an individual stock. I like to tell folks, think about how much time it took you to earn that $200,000 if you were to be in the workforce. Maybe you're highly compensated, and maybe you make $200,000 or more a year, but that's after tax. So you're talking about, maybe you've got to work, and earn $300,000 or even more. Let's say you're saving 20% of your income, so maybe you're making $200,000 a year. Just in short terms, that's 10 years worth of savings. So it's a substantial amount of money that you don't want to see go away. So how do you manage these concentrated positions? Well, there's a couple different angles I like to look at these things from. First, you have to look at your entire situation. What is the company that we're talking about? What is the credit quality of that company? What is the industry? Make some assessments there. Number two, what's the taxable liability of the situation? Is this stock that's all in a taxable account? If so, some of the decisions, but not all of them, are going to be geared towards the taxable situation. And then, of course, your investor risk profile. Are you that conservative person? Are you that aggressive person? Et cetera, et cetera. So we look at all those things. But at the end of the day, by having a super concentrated position in your portfolio, you're taking a substantial risk. And this can go sideways very quickly. Having done this for over 20 years now, I've seen some very good things happen with concentrated positions, and I've seen some really bad ones too. A good example would be, I remember being referred to a client back in 2006 by another one of my clients, and this gentleman had worked for GE. He was in his early or mid 70s, and they had about $1 million or $1.3 million, I think, in total investable assets, most of which was in an IRA. And he had most of the stock in most of this IRA in GE. So what we did was we diversified it out, and we sold the GE, and basically almost down to nothing, no taxable consequence. It was very easily a recommendation to make, and we diversified the portfolio out. Well, I get a call from my assistant that Mr. X, we'll call him, was on the phone. This is just 6 or 9 months after we had engaged. And Mr. X wanted to buy $500,000 worth of General Electric stock. And I'll never forget the phone call. I was actually on my mobile, and I took his phone call, and I said, Mr. X, I can't allow you to do that. And this would be potentially catastrophic, if something went wrong. And he was very adamant, that he wanted to buy GE. Well, this is 2007, and certainly had no omnipotence or any, vision to see the future. Didn't know a financial crisis was happening. We were forecasting a recession, however, and I told him as much. And General Electric had always been very similarly performed with the general market. At this time, General Electric was around 47, if memory serves. Now this is after this. This is before the split. They reverse split by 8-1 here just a year or two ago. But I refused to take the order because I was doing my job, and he fired me. Well, you know, if you know anything about General Electric, it's been a very, very awful story. GE, the next year went down to as little as $7, I think, a share from 47 or 42 or wherever it was when I refused to take the order. I heard through the grapevine after he fired me that he was very, distraught over it, and I was really quite sad for him. But it illustrates that nobody knows the future. You can have all the loyalty in the world to a company or to a stock. It has no loyalty to you. And when you're dealing with your financial life, you only get one. And you just don't want to put yourself into a situation that could go, completely sideways. In his case, dramatically affecting his net worth and his retirement. So I hope this has been helpful. If you have questions about a concentrated stock, something specific to something very general, or you have questions about your portfolio or your financial plan or whatever, please reach out. Please like and subscribe. Please follow us at richwealthmanagement.com. And thanks for watching.